Black Media. And it is my absolute pleasure to welcome you to How to Fundraise as an early stage entrepreneur. So, the mission of the National Black MBA Association is to lead in the creation of educational, wealth building, and growth opportunities for Blacks throughout all stages of their careers as students, professionals, and entrepreneurs. Realizing that entrepreneurship is the greatest equalizer of wealth disparity, we have been intentional this year about increasing our efforts in this particular space. So, providing the content for today's session is Sean Hill, managing partner at August Hill Partners. Sean's passion is collaborating with executives on the strategies that will enable them to scale and ultimately exit faster than they can on their own. His sole goal is to be a facilitator of the great ideas that originally formed his clients' businesses. Sean is an active member in many organizations helping underserved founders, startups, and aspiring investors as a mentor for several prominent VC accelerators, incubators, and funds. And we are so thrilled to have him. Sean, welcome.
Thank you, Paul. I appreciate it. And to Robin and the rest of the organization, as my bio said, but I'll tell you, really passionate about access to capital for all founders, but especially those of color. I am an entrepreneur now as the last few months. So it's been quite interesting as I've gone through. I worked in corporate most of my life. The last 4 years as a partner in a venture fund in Chicago named Modern Ventures. It's a couple $100 million under management. I never knew what venture capital was growing up. I didn't go to school for it. I sort of took the long route, but I ended up there. And part of the reason I chose to start my own firm was to give more access to more folks. And I'm really just excited to create a company that I can be helpful and that I can really pass the knowledge on, because you'll see in some of the slides here, a lot of what I talk about is access. And access is something that isn't proportionally distributed to everyone. And so I'll talk about a few of those things today, but I couldn't be more happy to be here. The format today is I will go through really just sort of definition of venture capital, and I'm using venture capital really as a proxy for all forms of capital, but it's just the most traditional one that people will go down. I'll explain some of the differences today. I'll go through a section. First is just an overview and really of the industry and what people are looking for. I'll stop and ask a few questions. So if you want to put your questions in the chat, I'll answer a few. I'm very conscious of time, so I will make sure that I answer as many as I can before moving on to the next section. The next section then will just be like, what are investors looking for? And you need to, before you even come up with your great idea, you need to know if people are willing to give you money for that investment. So we'll walk through that. And then finally, really, we're going to talk about just field terms, lingos, potential things that you may hear if you're an entrepreneur that you're going to hear. It really is a second language that most entrepreneurs need to learn. You are talking to investors that do this hundreds or thousands of times, and it's your first, so you need to be educated, and I'll give you a resource to help you do that. But really today is just about access and information. We all know that power, and so the more that I can share, the more people will get interested. Most of the time people aren't entrepreneurs because they just don't know how they're going to pay the bills. They have a great idea. And so part of investors are getting you money to build your project and to go to market and to make sure that you've got food in your stomach. So without further ado, I'll get into it and we'll open up for questions later. So the first thing I wanted to talk about is just a definition. So what is it? I didn't know what venture capital was till very late in life. It was nothing that I ever knew, but here's a really good way to take a look at it. So basically it's capital invested in a project, or you can think of it as a project or a company in which there's substantial element of risk. So being an entrepreneur is risky, as we all know. and it's typically in a new or expanding business. And we'll talk about the difference between new businesses and expanding businesses as you go through the presentation, but really that's all it is. So it's typically going to be money or some percentage of your company. And it's almost a necessary evil to take capital. There are some firms that don't take money, but we'll walk through some of the differences today. So what are, and I'll use VCs or just venture capitalists. So the people or the firms, what are they looking for? So when you start to think about your big idea, really the thing that most people are going to ask is the problem important? So it may be important to you, and it may be a passion of yours, but we'll sort of walk through some of the other things that it needs to address. And I think the key term here is big, and we'll talk about a little bit about what investors look at. But if the problem is for 1,000 people, it's not so interesting to an investor. Problem for 1 million people sounds like a big number, may not be that interesting to investors. Is the problem big enough that it can be everyone in the US, everyone in North America, everyone in the world? So the larger the problem, really, the more what we'll call addressable market there is, and we'll get into a little bit of addressable market today. But if you can't get past it, this is a big enough idea, it may be really painful to you, but if it's not painful to a lot of people, you're not going to get investors really interested in it. So that's really the first one. And as you can see here on the left under number one, passion, passion, passion. Most people start a company they're really passionate about. That's great. It also has to be big as well. So if we go down to number two and say, great, who is the founder and who are the people that are going to execute on this vision? So ideas are great, have to have a team to execute. So you've heard it's not about the idea, it's about the execution. The number one question that I ask of my clients or any startup founder is, why are you the person to solve the problem? And sometimes I get a look of this, what do you mean? Of course it's me. But there really should be, and some of the bullets below that is, what is your experience or education or track record of doing something like this before, right? So an example, I work with companies in the real estate technology space or financial services. Well, the only reason I could go and start my own company and doing that is because I've been doing it for 25 years. And so I have a track record of doing it. I have the experience to do it. My education is in that background. And so that's going to give me some validation for my clients when they say, Sean, why you? Why would I pay you money? Why would I talk to you? And so it doesn't matter if you're selling ice cream, why are you the best person to sell this ice cream? And so you need to have a really good answer for that. And you don't necessarily have to be the only expert. That's why there's co-founders and team members. And so what I tell people when it comes to their founding team is, find people that have a different skill set than you, so you can answer the question, why you? And you can say, well, I've never sold ice cream before, but my partner was the head of sales at Ben & Jerry's. So I'm really good at other things that are going to help this business, but that's why me and why the team. So you can see complementary, passion, personality, and as an early stage investor, you are investing in the idea, but mostly you're investing in the team, because we don't have enough data to say, there's not 5 years of financial data to say whether this is going to, whether this is going to succeed, because we don't have that traction. So we're investing in you. Is the product unique? Number three, what's your secret sauce? You'll hear a lot of times. So what makes you special? I've rarely ever seen a business where there's only one solution. And if there's one solution, it's probably only going to be for a very short time, because if it's really that good, someone's going to copy it. And speaking of copy, the next question is it defensible? What makes your product or solution or technology unique? Is there, can you patent the idea or the solution? Can you, is there some piece of data that you are collecting that no one else has? And so really, and then is predictable? Is there intellectual property that you can go and protect? And that's really important. It depends on what sector that you fall into, but if it's highly technical, can someone just copy it? Is it a business model that you can just copy? And then you're going to want to know, and this is very important, is who are your competitors? I don't care if you have the best idea in the world. If your competitive side has Amazon on it, really, really hard to succeed. Not that Amazon's going to do everything. Well, maybe they are going to do everything. Maybe they don't care about the segment that you're going after. But if a massive Fortune 100 logo is in your competitive sphere, it just makes investors think twice about, is this market big enough, again, back to number one, to support both of you or six of you? And it doesn't mean if someone's doing what you're doing today, doesn't mean that you won't get investor funding, but you're going to have to answer the rest of those questions to get people really comfortable with why they would take a bet on a brand new startup versus a proven business model. So speaking of business model and large markets, so how big is and we just call this addressable market. And so I'll just clarify that term as addressable market. So there's typically something that's a market, and maybe if you're a consumer, that could be everybody. But really, what is the addressable market? And maybe my addressable market is 18 to 34-year-olds. Not everyone, even though everyone could use TikTok. The addressable market is typically one of those segments. So who is the market that you're actually going to address with your product? Very few companies say everyone. Because it's just not realistic. And then what's your business model? And so business model is how you make money. And so how are you getting paid, number one? How are you acquiring customers? And so that CAC is known as CAC, so it's customer acquisition cost, versus what's your long-term value of that customer. So we see an advertisement, that's a cost for Pepsi to acquire me, right? And so how many Pepsis do I drink over a lifetime? Or how many Pepsis do I buy a week is how they would calculate long-term value. So how do you reach those customers? How are you going to monetize those customers? And then how long are they going to stay with you, and how much are they going to spend? And then some of the other questions here as to who else is going out, and then question of how do you get to those customers? Am I going to compete for television dollars with Coke or Pepsi? Probably not. So what's the way I'm going to get them, and how do I get them? And then finally, timing. So not only the question of why you, but why now, right? So that's really a combination question: is now the right time? Did you miss the boat already? Are there 17 people already doing it? Okay, well, there's 3, and why you? And then it comes back to the question we just asked. And then what's the plan? So everyone has ideas, and everyone has passion, and everyone thinks they have the secret sauce, and everyone says it's a massive market, but what's really the plan? And so after you've done 1, 2, 3, and 4, 5 is where the rubber hits the road, where you've got to put pen to paper and figure out, how am I going to do this? So how much can I raise? We'll get a little bit like where you should be, some benchmarks. What am I going to do with the money? I get this all the time from my clients. They go, all right, I just spent 6 months fundraising. Now I got the money. Now what, Sean? So it really comes down to, do you have a plan? Who am I going to hire? What positions? How much goes to sales? How much goes to product development? How much goes to marketing? All of those things. And that really talks to like, what's your growth and your milestones. So who else is investing? A lot of time investors want to invest with other people that have successful track records because they think they know what they're doing. Who is going to lead? And I'll talk a little bit about that in a little bit. But as an investor, the question always comes to, how can I be helpful? I'm now giving you the money. Great, you can send me a report every quarter, or can I be helpful with my network or my experience? And then what's the end game? And some people create a business to create cash so they can live the life that they want to live. Fine. And it doesn't necessarily have to make them millions of dollars. It just pays the bills. And some people want to have a $1 billion company. And most people are somewhere in between. And so what is the end game? Do you want to grow this into something really massive? Do you want to have what we call a lifestyle business? And you probably don't need venture capital for a lifestyle business. And so these are all the questions that you should be asking yourself. So when a venture capitalist says, hey, tell me about your idea, you can start to answer these questions. So I won't go through all these, but here's just some investment criteria, what venture capitalists look like. So I'll start on the left with the company. So, where is the company? And this is sort of, looking a little bit behind the curtain, some of the questions we ask. So where are they? Are they just developing? Are they have a product that's in market? Is it beta? Is it a prototype? Do we like the concept generally? Do we see, is this something that we've invested in before? So, we know the area pretty well and we think there's a need for it, and then backs to the need. The next question is there any synergies with my portfolio? So I already have a portfolio of companies. Maybe this would be great if we had these two companies together, one could buy the other one. I always ask this question because is my portfolio a customer of this new company? It's great if you can sell to your investors' other portfolio. It's a built-in customer, right? So that's really the customer. And then commercialization, what's attraction? People say, great, how much have you sold it for? And if you guys watch Shark Tank, I'm sure which everybody does, one of the questions they always ask is, what are your sales? And that's what this means. And some people say, well, I've sold 4, and some people say I sold 4,000. And some people say I sold 4 million, and there's a difference, between all of those. So we're certainly going to ask them. If you go over to the top right-hand corner, after the company is the team we just talked about, the relevant experience and education. Are they missing someone? Is there somebody complementary that maybe we can add, or someone that we can tell them, it'd be great if you had a technical co-founder. It'd be great if you had a sales co-founder. Do we like them? I know that's a little bit, that's not a very subjective objective way to look at it, but people like to do business with people that are interesting and they like and have similarities. So, so building that. And then again, what's the execution or attracted so far? So a couple of these are, reviews from the last slide, but these are, so you saw the first view was from the entrepreneur's perspective, looking for, and then this is, when we go in and take a look as a team and say, we're all looking for that thing in the center, right? This potential unicorn. So these are all the things that make up, is this unicorn? And maybe we've heard the term unicorn as someone that's worth $1 billion or more. And so if you think about companies like Uber or Airbnb or LinkedIn, all of those tech companies started somewhere with an idea and ended up, either going public in the stock market or potentially raising some money to get there. So it's all about, these are all definitely relevant, but you need to ask yourself these questions. Some of the things, if you just look in general, just to give you a sense of scale and size, potential to be worth 100 million to 1 billion. A lot of money. So that's not how much you have to sell, but how much you need to be valued for generally for investors to be really excited. And there are all shapes and forms, and I'll go through that in a little bit, but generally someone says, can this be $1 billion company? And if the answer is no, then the answer is no. And so, maybe figure out, are you selling to a different segment? Is the market not big enough? All of those questions. So just some questions to ask as you get there. So I wanted to talk through a bit of so we talked about what people want. So then what are the ways that I could go fund my entrepreneurial, company idea, whatever it is? And so I'll walk you through these here. So the first one, pretty obvious, but I can just pay out of my pocket, right? Or my savings or whatever I have. So I knew that I was going to start this business. This is how I'm doing mine. I said I knew if I had this idea for a long time, so let's start stacking away the pennies. And when the stack gets big enough, we said this is how much we've done a business plan. this is how much we think we're going to need. We don't want anyone else to have equity in our company to start. And so we're just going to put some money aside and pay for it out of pocket. So one of the ways that I'll look at this is just sort of advantages and disadvantages. So self-funding is great. I own 100% or 50% with my partner. No one else owns anything, but all the money's coming out of my pocket. So number two is friends and family. And a lot of times this is how many businesses start. So I have a good idea. Maybe I have a little bit of my own funds, but I need more and I'm young, and maybe my parents or my grandparents or my rich uncle or someone that I know, has the money and sees how passionate I am and loves my business plan, and they're willing to give me, to just get me started. Maybe I build a product, whatever it is. And so this is typically how many businesses start. This is not typically how many businesses of color, people of color start. So, there's some statistics. I did some work for the National Association of Latin entrepreneurs, and many Latin and Latinx, 70% of their businesses are started friends and family. It becomes a cultural thing. What happens? That's not the same across for other races or ethnicities. It's not typically the case. We all know that the economic disadvantages people of color have, so less of their friends and family have money to start businesses, so they don't start businesses. And so it becomes this vicious cycle. And the good part about it is you get pretty good terms and it's part of your money because it is your friends and family. But then it becomes, I owe my uncle money, or I owe my dad money, or I owe my grandfather money. And so typically there's not great dynamics that come with that, and not great access for conversation. So it is a way to go. It's how a lot of people go, but it comes with not everybody has equal opportunity, just based on socioeconomic factors. So we've all, I think, got some sort of crowdfunding app that's come by, Kickstarter or whatever that is. So I've got this great idea. I put it on a platform like Kickstarter, and Joe Smith from Iowa, who I've never met, loves my idea for these rollerblades. And, he wants to put in $10 of my $1 million that I'm starting. So that's an example. We've all seen those before. And so there are platforms that are built where you can say, I'm willing to give up this much of my company for this idea, and then you can crowdsource those funds. And so typically they're pretty specialized in how they, those platforms and how they operate. Again, it's getting access to those platforms, and also just like the reliability of funding, right? So you put it on the platform, cross your fingers, close your eyes. Hopefully the money starts pouring in. You just never know. So it's not a very just reliable way to fundraise. So we've heard of the term angels. And so these are typically wealthy individuals that have made money and now are looking to get into really early stage companies. And it's almost a path to becoming an investor, but just a single investor. And so some of these angel investors invest on their own. You'll hear the term angel groups. And so some investors will get together and sort of share the risk. But these typically are wealthy individuals that want to get into the investing space, want to find the next Uber in the first round, take a bunch of it, and own 1%, and it's worth $50 billion at some point. And so typically those are going to have some domain expertise. They may say, this is how I made my money, and I like this area. They may be helpful, but again, access. If you don't know who these people are, you're never going to find it. Now they're moving to more and more platforms to do this, like the crowdfunding. But typically, this is a network that most people on the street don't have. And so again, access. You'll see this on most of my slides. It becomes about access. So one great way to get money is through grants. And so, in getting a grant, typically that money comes with no strings attached or few strings attached. So from the government or from your state or from a corporation that says, we're willing to give you quote unquote free money but you have to meet this criteria and you have to have this documentation. And it goes to one person out of 1,000 or one person out of 1,000,000. And so, the great part about it is I wrote the word dilution. So typically there won't be much of like, hey, we want to own your company. A lot of this is government or corporate that are just trying to fund innovation. But so that's great. But again, it's how do you find out what the access is? I'm not an expert in grant writing, and so there's companies that can help you do that. But it is a really good way to get money if you're not in a like rush for tomorrow, because some of these only come out once a year. Family office. So a family office is typically an individual or a family that made lots of money and now creates an office to invest that money. And so large supermarket chains, like I live in Chicago, and so the Mariano's, the supermarket chain, they have a family office, and so they can invest in anything they want to. Some of these family offices want to invest in early stage technology. And so sometimes they do that together, sometimes they do it as a group, just like the Angels were. But typically these are very, 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 very rich families. So what does that mean? They like to typically invest in the area which they made money in. So if I'm in a supermarket, I probably do agricultural tech, or I do something retail or something of that nature. But they can be very strategic to you because they have reach, and they're typically well networked. But again, access. You can't just there's no website to go to that say, hey, do you know any rich family offices that around? Like that information isn't very public. So again, it's access to those. But if you find someone in your network that has some connectivity, it's a really good source, because unlike venture capital funds, they typically don't have to fundraise. And so the expectation is different. As a venture fund, you're typically fundraising every 3 years, and you're saying, look at all the deals I did and look at how much they're worth now, and hey, give me more money. And so the family office is kind of generationally rich, and so they don't really have to do that. So their expectation can take a little bit longer. There's a new form, which I think is interesting, especially to maybe people that are starting today. It's called Venture Studio. And so what the Venture Studio does is it has access to companies. So they may have their own development staffs, product development. They say, hey, great idea. I'm going to help you build this thing, but I'm also going to take a big percentage of your company to do that. If they like the idea, they have typically developers or marketers on site and will help you accelerate getting to market really quick. But again, there's some dilution issues because they typically take a lot, but it's a trade-off every time. And then finally, I won't spend too much on this, is the venture capital. And so the only thing I'll really talk about here on the venture capital side is, and you've heard the term incubator or accelerator. And so I'll go through on the other slide what incubator and accelerator mean in a little more detail, but really incubator is more of I'm building a product, and accelerator is more I have a product, I just need more customers. So last one here, for just from a valuation perspective, typically how do we value the company? Like where would you go in the valuation? And so if you're a brand new company, you're typically less than $2 million. And so that would tend to be your friends and family, as we just talked about. Typically, if you are less than 10 million, you're in the angel range, and then your traditional venture capital, 3 million to 200 million. And then really big companies go in either public or in so this is where you'll typically see your venture funds invest. And then and the low end, some of the venture firms will then invest with angel investors. On the high end, they'll typically work with into that just yet. So that should give you a pretty good sense. So I'm going to answer some questions here. I think we have. So it's about passion. So how do you judge the passion of a founder? Are there stories or their actions? Well, I think for everyone, actions speak louder than words. And so anyone can say they're passionate. I can just tell, you can see it on someone's face. Maybe it's just because I listen to a whole lot of a whole lot of pitches. And so, I can see when someone's passionate about it or not. The stories are great. I would say the action is what you really want. The story just backs up the action. Is the story believable? So I'll try to get through this a little bit quicker. So I have purchase orders, trying to get investor. Purchase orders. So interesting. So, I would say Ed says, so he's got some contracts and so he sold something, but he's trying to get investors and working capital. So I think, Ed, my question for you, there are some companies that do what's called factoring. And factoring, sometimes it's just a fancy word, it's just sort of like on accounting. And so companies will front you the money for purchase orders. In order to deliver on those orders. And some other companies will do some other things around debt for purchase, for instead of capital on the venture side, there'll be more sort of debt financing you can get. But what the purchase order will allow you to do is go to investors and say, I have these coming, I just need the money to fulfill them. And so depending upon the investors, some investors will get more excited about that. Slides available. Yes. What's your take on solo founders? Great question. It's very hard for solo founders. I'll just say that. Venture firms are just betting on one person. One person can only do so much. I would say most solo founders go and find a co-founder, a later stage co-founder at some point, really just to help fill in some of the gaps that they don't have. So good, not great. Do you need a business plan to pitch an idea? The answer is yes. No one will listen to your idea without a slide deck. And I think the other one, Chelsea, that would take a long time. Any tips to simplify your business offerings when pitching? Yes. 12 slides max. That's my, if you can't say what it is in 10 to 12 slides, then start again. So I'm going to move on just a bit. Oh, there's probably one last one. So your thoughts on addressing a niche market that has a large segment of the general population? Absolutely fine, Mikkel. Like, it's okay to go niche. It just has to be a large market. So real estate is a large market, but you could serve one niche in real estate. That's still a large market. So absolutely, just make sure the market, when you do your addressable market, it has a B for billions in front of it instead of an M. Cool, great questions. So, all right. So we talked about this a bit. I'm going to dive a little bit deeper, but really the idea, and I'm going to look and go in just one of these areas that I think is important. So the idea we talked about, I'm going to go to the last bullet point of total potential of the idea. And so it's a good question that we just had the question that just came through. So there's a few areas that you need to look at, and that is in the addressable market. So if you were to say, and I think the TikTok example was great, is anyone can use TikTok, but how does TikTok make money, right? And so TikTok, plenty of those or Instagram or any of those make money on advertising. And so advertisers will pay for the people they think that will buy their products. And so can you find a segment in a massive market to service? And so if you are selling skateboards, your addressable market is not over 60-year-old, and I'm just generalizing here. It's probably not less than that. And so you're going to say, great, I want 12-year-olds to 22-year-olds, right? And so then how much do 12 to 20-year-olds spend on skateboards a year? And so you find that information. And so that again becomes your addressable, that might be your addressable market. And there's also one that's called a serviceable market. So I may have the addressable market as all 12 to 20-year-olds, but they're very specialized areas, right? And so maybe I say, out of those 12 to 25, or out of those 12 to 22-year-olds, I want the ones that have purchased in the last year and live in California. And so that market gets a little bit smaller and smaller. And so you see everything starts at a very large pie and then gets dwindled down and dwindled down and dwindled down. And even if that pie is 12 to 22-year-olds that have recently bought a skateboard that live in California, that can still be a massive market. And so make sure the idea is big, but the addressable market also has to be just as big. So make sure when you're thinking about your product and where you're positioned that you have a really good idea on what is the potential market, and then you can say, here's why my market is big, and then show that to your potential investors. So we talked about this before, so I won't spend, I know we're around some time, so I will go through a bit of these. I wanted to talk a little bit about how much you're fundraising, so let me get to those slides here. So these people say, how much should I raise, Sean? And so these are some really good, just general segments of where you should look at. So if I'm in the idea phase and I need to build something, you'll look at the investors as I came down there. So can I fund it myself, or can I take out a loan to do that? And typically that's going to be less than $250. It doesn't have to be $250. You can start with $5,000, $10,000. It all depends on what you're trying to build. But typically that's where you're going to be. And if you see your traction is, I only have a concept, I've got a few customers identified that we think I can sell to, and the market opportunity is pretty big. So if you just sort of come down the column, we'll tell you, and these are just averages or typically what happens. So now I've moved to the next, round, we call it here. Typically you'll see across the top is a stage. So I'm in the pre-seed mode and I'm gonna look to raise a little bit more. So raising a little bit more means I probably can't do it myself. I need to go out to my network of friends and family, find some angel investors. And here's probably the first time where you get to venture capitalists. So before, in the ideation phase, you still need a business plan. You still need to have, things going, because eventually you're going to have to, raise more money at some point. And so what's important to look is really the traction as like, I've got a prototype, I've got some customers now, targeted the right segment. We just talked about the segment. I know I'm going after 12 to 22-year-old skateboarders in California, and I've got some revenue. So that MRR is monthly recurring revenue. So how much do I make a month? And typically that's going to be a gross. So not how much do you put in your pocket, but how much money do I make on a monthly basis so far? So you can see it's on the lower side. And as you move up, the capital raises start to get bigger. The investors change. And so when you get to this seed, it's typically going to find traditional venture capital and angels. And then now I've got some really strong usage from my customers. So I've got people buying. I know who my segment is that I'm selling to. The POCs convert to customers. So that's proof of concepts convert to customers. So as the first half of the question, I've got purchase orders, right? And then now my monthly recurring revenue gets a little bit higher. So now I've hit $25,000 a month, typically, to about $100,000 a month. And here's where we really start to take off. So you can see the round size is starting to double. You can see the investors now, these are institutional VCs, very large professional organizations. We've got strong growth. We've added people to our management team that have different capabilities. Maybe we now have a chief technology officer, and we have a chief marketing officer. We've now started to fill out our founding team with just not the founders anymore. And now we're looking at annual revenue, ARR, of $2 million a year. And that's really the benchmark to clear, to hurdle to get into Series A. So a firm would say, we invest in companies at 2 to 20 million in valuation. And what we talked about before, and then my capital allotment would be, the raise is somewhere, between 4 and 10 million. These are just guides, right? And then, but if you didn't, and then this 3x year over year growth. So did you grow Did you grow 3 times as much as last year? Are your sales 3 times as much as last year? And then we start to get into things that are called growth rounds. And you can see now we're looking at larger amounts of funds. Now in Series B, we're looking at product lines. We're looking at maybe a different product, maybe version 2.0, maybe a different vertical that you're selling in, different segment. And by the time you get after that, now you're the market leader, you're predictable, you're profitable, you've got $15 million, and now let's go to Wall Street. So that's typically how the investment stages work. Again, they're just guides, but I think it's just a really good way for people to visualize when they hear the round seed, Series A, Series B, like where that is, who the investors are, and what kind of action you do. So I'm sure there'll be some questions outside of that. Happy to answer those now. So my contact information will be on the last slide. How does a VC judge a social entrepreneur? I think it goes back to answering those first questions. There are venture capital firms that have a social impact mandate, so I would find some of those. There are corporations that have investment mandates for social impact. But it still has to fit a lot of those other criteria, or else people aren't going to give you money. So you can get to those numbers that I talked about with social impact, and hopefully you do. So that doesn't preclude you from raising interest. Is a prototype required for making a pitch to a VC? If it's a technical product, yes. No, let me rephrase that. There are some venture studios, there are some people that say, I will help you build a prototype. So if you don't have the money for a prototype, you may want to go down one of those paths. I would say at least wireframes or something that people can visualize what this is, like coming to someone with an idea and say, this is great, like really hard to get money without like visually something to pitch to. It's gonna be really hard to do that. So what are the chances of an organization duplicating your idea and approach? You should go into every conversation thinking that your competitors are going to duplicate your idea and approach. So the chances are 100% if they want to, because typically if your competitor is big, it's just a matter of focus. So they're just going to say, do I care enough about this segment? Is there enough money to be made for me to do it on my own? Or am I just going to wait for someone else to do it and then I'll just put it in? So the patent process, it depends how technical you're getting. Sometimes you need a patent, sometimes you don't. Highly technical, deep technology patent is a good thing. It's not required everywhere else, and sometimes you can't get it. Depends on what's there. It's better to have an active product on the market that's making money versus a pitch with an idea. The answer is yes, it's better to have an active product on the market that's making money. Pitch deck is just a pitch deck. And so it's all conceptual. You haven't executed on anything. Why are you the person? So the answer is yes, Brandon, like, yes, get it in the market so you can get traction. Is there an option of problems you should discuss that are solving? Or should you address one? I would say to start, address one and make sure it's big. If it's not big enough, maybe you want to address a few more. Have you seen investments in technology research? Yes, it's not my specialty, but I've seen investments in everything. There's money for every idea in every space in every domain. Again, there's money. There's so much money out there. It's just finding access to it. What are reasonable terms for early angels? Great question. Probably takes a little more context to that. Typically dilution rounds early will be 20 to 30%. So just like you said, as a proxy, but you're going to give up a lot early just because you tend to have to. So, I'd say just think about dilution at 20 to 25 to 30%. So research companies, yes, you can get money for anything, Candace. So you just can. Long question, Wesley. I might have to skip that for just now. Financial projections. Yes, financial projections are necessary, but no one believes them, but they're necessary. So let me try to finish on the others before I get here. But let me just see if I can pick something out here. I have a team of advisors, a prototype, so it's been challenging reaching the VC community. What ideas or tips do you have? Okay. What ideas do you have as a donor to getting a meeting? I would say be deliberate in your networking. If someone says no in a meeting, ask if there's someone else that they know. Have an ask when you go into a meeting. I ask people all the time, how can I be helpful? And they have a blank stare. And I said, it's really hard to get me on the phone. And now I asked you what I can help you do, and you can't tell me. So make sure you get that. You have your questions going in, but network. You're going to get told no 200 times. Don't get discouraged. I think is what I'm really trying to say. So say hi. Do you think VCs will need some? Yes, Clarence, yes. I'd love to talk about it. I'm super passionate about that angle. I think it's great. I think it helps take out inherent biases that we have or learned biases that we have. So the answer is yes, and contact me. I'd love to talk about it. Can you negotiate with terms with angels at a later date? Everything's always negotiable, but you should negotiate up front. People are less apt to negotiate at a later date, but you can certainly ask, but why they typically have the leverage. So it's maybe a learning experience you learn from someone else. And can you discuss other approach questions about scaling? Yes. That's a big question. Takes a lot more than a few minutes that we have, but I would say just in general, have a plan for distribution. Like how are you going to sell this thing, whether it's direct to consumer, whether it's through a partner, whether it's integrated into some other solution that has scale. I would say I would always do, if you can answer those three questions, it's going to help you just answer the scaling question. And do you know any angel investors in the beauty industry? Good question. Just ask me after. I know a bunch of other industry folks. So let me try to get to the end here. Got about 10 minutes or so. Thanks. All good questions. I think I got to everybody. So just a little bit deeper into, I talked about a few things, the capitalization and dilution. So I don't have to read all this. You can read it before I read it to you, but typically that first bullet point, which I shared, typically VC firms typically seek to purchase 15 to 30% in each round of investment. So that's something when you sort of talk about dilution, you'd just be expected that that's a general key term in how to do that. VC firms will also often syndicate deals with other firms. So this is a risky business. And so they may say, I'm going to put in some here, but I'm going to go find some other folks that I know that tend to invest with me. The term is co-invest. And so I'm going to help diversify some of my risk by finding others that will do that. Typically a venture firm will, if I have a $50 million firm, I'm going to invest the first 25 million or around the first half of it in the first three to 5 years of my fund. And then I'm going to keep another 25 for what's called reserves. And so I then have this pool of capital that now I get to see what happens with my portfolio companies, and then I get to double down on the winners, right? Just like we would do in Vegas. When you find a winning hand and you have an 11, you want to double down because you have a better, you've got better odds on the other. So remember, venture firms do the same thing. I'm going to keep money for the winners. I'm going to keep putting money down where I think I'm going to get the most return. And then there's just a small sort of valuation chart on the bottom. I won't go into all of that, but you can see here. And again, I think we're happy to share some of the slides as well. So Couple of just deal structure terms that you may hear. There's really a couple of different ways. So you may hear of a safe or a simple agreement for future equity. That was developed by Y Combinator, who's a big incubator accelerator. And then there's this KISS document as well, keep it simple security. And so these are the terms that you're probably going to hear most often early on. And they're really meant to just help like get you to capital quickly with terms that you like. And so there's an organization called the National Venture Association, NVCA, National Venture Capital Association, sorry. You can go onto their website. They typically will have these forms. They're very standard. I would make sure if you're negotiating that people use NVCA forms or these KISS or SAFE forms, because they've already been vetted by a million lawyers and all the questions have been asked. And so you're not trying to do something unique that you don't understand or that no one else understands, or more importantly, your investors in future rounds won't understand and may be turned off if your deal structure isn't done properly. So that happens plenty of times. So you want to make sure that you use just the standard forms when you go out. And then just any information on those forms and studying those forms is just going to help you, like, what are the terms? So I pulled out a few terms. One of the things you'll hear is valuation caps. We talked about valuation. So what is the cap? The maximum value. This is really for stuff on convertible notes, as to when you look at some of those and some of these notes above, there will just be a valuation cap, which will then trigger other events. And so I'll just leave it general in that statement. So these are discount. I won't really get into here, but sometimes in some of these notes, you will, the investors in the next round will if you invest in this round, you'll get a discount to the pricing of the next round. MFN is pretty standard across a bunch of legal contracts, but most favored nations means if I put in a most favored nation, means whatever, I always get the best terms, regardless of who comes after. So that's great for the investor that puts that in. It's not great for the other investors after that, right? And then what information as an investor do I get from you on a monthly, quarterly, annually basis? And so investors want to make sure that they have the right information so that they can make the right decisions. And then some of the other ones are a little bit more detailed, but to go into there, I put the little book up top for more information on deal structure. This is sort of the venture Bible. Down there is venture deals. If you're serious about it, it's worth the time and the read. That you should pick up and start to educate yourself on. Some of the other just deal questions that are here. I won't go through all of these. If you can see right here, number 4, are they world-class entrepreneurs, inventors, leaders? This comes back to YU. These are some of the questions that are asked during due diligence. And then really the VC's job is to push the venture to the next stage, as I told you before. Venture capitalists, their fiduciary responsibilities to their investors. So I go to my pool of investors, I raise $1 million. I'm going to invest that $1 million. My job is to return multiples on that $1 million back to the people that gave me money. So 2 million, 3 million, 4 million, 5 million. The more million, the better. What people don't realize is that the fiduciary responsibility is to the investor, not to their portfolio company. You are a means to an end. The better your company does, and the more your company sells for, the best valuation is the equation that goes back into that money I return to my investors. So I do want to provide coaching and advice and strategy and all of these things and use my leverage. And so many venture capital firms will market themselves as what they call smart money or domain specific money or strategic, because they have these relationships. If my portfolio companies only sold to my investors, they would have great companies. And so we pitch that all the time. And so if you could just sell to my network as a client, you probably have a great business. And so, our job as venture capitalists, my job now as helping startups is to facilitate the introductions to the next stage venture firms, because they're going to typically have a higher valuation. They're typically going to take the team to the next level, as you saw the charts that we have. As you move along that hockey stick from ideation to public, your venture help you do that. And really, here's just some deal lingo, and it really goes back to what we just said. So if someone said, I'm raising a safe note with a 4 cap and a 20% discount, sounds a little bit like Greek, but really we just talked about, that's a safe note with for $1 million cap, and whoever comes in gets a 20% discount. So sort of the translation underneath, but that's the lingo that you'll hear. And so it's really a translation of what investors are talking about. So I think somehow I timed this pretty well to only have a few minutes left. I'm happy to answer any sort of final questions on anything that we talked about today. While I'm doing that, I will just put up the SurveyMonkey link and my information so everyone has that. So I think we answered Wesley's question before, so let's get over that. Do you know any VCs or angels? I think we answered that question. Contact me. Oh, sorry, I didn't put my email address in there. So it's first name, augusthill.co. Let's type it here. Yeah, sorry. So yeah, maybe someone type it in the question for me just so everyone has it. It's just SHAWN. Have you seen any VC investments in startup management consulting firms? So since I'm a startup management consulting firm, I haven't raised money yet, but there's certainly places to go on the investment side, basically. So it's a little bit unique. You probably have to have some clients and some traction, and to go there. It's not a typical way that venture capital investments would go, because the income is a little bit different. They typically like recurring, and management consulting firms aren't. So there's a little bit of nuance to that. But the answer is yes, I can tell you, because I talked to VCs about investment. It's just a little bit unique. In regards to exit strategy, who exits? So I think what you're asking, it's SHAWN at augusthill.co. So you see the website on the bottom left, it's just my first name. In regards to exit strategy, who exits? The company, the startup exits typically to a buyer and at a valuation, and then based on how much the venture capital firm owns in the company, then that's where their return comes. So if I invested $100 at $1 million valuation and it sold for $5 million, I could 5x my return, and so that's the exit, and that's how venture capital make money. So I think I'm at the end. I have 40 seconds left, Paula. I think that's I don't know how I did it, but we're there. It's all you. So
it was timed perfectly and incredible information. Thank you again so much for your time and for this incredible session.
Yeah.
Thank you all for joining us to listen in. I trust that you also found the information to be valuable, and we'd love to hear from you. So you'll see the survey link right there. The first 25 people to complete the survey will be entered in a chance to win an Amazon gift card. So do not delay in providing your feedback. Sean, again, thank you. Thank to you all, and have a wonderful rest of your afternoon.
Yeah, thank you, everyone.
Bye.
Bye.